Dima, pleasure seeing you here again.
Likewise. Thanks for having
Uh,
me.
fortunately, we have enough patience to go uh, to dig deeper in this field of U.S. tax system, and that is why we have the second meeting, the second webinar on this topic, because you have prepared quite impressive presentation, so we couldn't fit it into one session. So this is the second session, and I'm not sure if we'll manage to run through the whole presentation. And I think it's totally fine because there could be some extra points to add. So today, for those people who will join us online, we'll be happy to host you, but most probably it will be watched by our auditor on YouTube. So everybody who is watching us on YouTube, you can definitely ask questions in the comments, share your thoughts on what is your experience on the US. If you watched our first webinar, you can come also and ask from your practical experience things that you're worried about, you want to clarify. We'll be happy to answer them. So first part of the trip was dedicated basically to the intro and to the simple things to the forms and to the most spread, let's say, forms of ventures which you can have or you can get as an entrepreneur in the US. And we have discussed types of forms that you need to file, types of risks that you can face while you run your business in the US. Few of them. Also, we have discussed LLC as one of the most convenient instruments to start business, the way you can start business in the US. And we have discussed some taxation matters uh, which you can face while you run LLC. And if you're a non-resident in the US or you're resident in the US, there are some specifics. So if you want to get more about this, uh, just watch our first webinar. There are a lot of details that could be very useful for you. So, Dima, stage is yours. Welcome back. Please
Wonderful
remind us on which slide we have
slide.
in the
Yeah.
last meeting.
Uh-huh. Right. That's precisely that. Thank you for introing into the second one. You actually, in your speech, you mentioned a formidable word. I don't know if you were aware of that. You said auditor. Auditor is going to look at it. I was like, okay, maybe. Maybe they will look at it. And we're not going to say anything obnoxious that they're going to get anything out of it.
Mhm.
All right, awesome. I think that, and this is, I also went through summary here,
Yeah,
but you
let's start
basically
with
did
that.
an excellent job. Right, this is excellent job. We looked at transparent and opaque entity. Transparent is when you pay tax, when investors pay tax, shareholders pay tax, and opaque is when the entity pay tax, and then you get dividends
Mhm.
distributed. We're going to look at it in a moment. Then we did speak about the effectively connected income and its dangers, and
True.
need to stay away from it. Another part is FDII, fixed determinable annual or periodic tax
Mhm.
on gross income for transparent entities, also a risk to be aware of. And then we talked about when it might make sense to be a transparent entity. We're going to talk about it today again, once we're going to compare the two of them a little more closely.
Mhm.
Now, we talked about the forms for transparent entity, Form 1065 and corresponding K1s, 2, and 3s. for the US entity. And of course, for non-single member LLC, if you open an LLC in the United States and it's just one owner, I think that's the most dangerous in terms of the amount of penalty that you can get for not complying.
True.
$25,000 per form, missed form. So that's what we covered, all of that. Definitely look the previous portion. Here's the continuation. I know we touched upon it last time, but let's just quickly go. Now we're going to talk about opaque entity. Opaque entity, again, is a corporation. We call it United States. It's usually in the form of C corporation, but it can also be an LLC that has elected to be taxed as a C corporation. So there's a special form you have to file 8832, and you have to tell the IRS, okay, guys, I'm an LLC, but from this date on forward, I'd like to be taxed as a C corporation. If it's more advantageous, of course, so you can do it. And it's easy. There is no tax involved. Is the easiest thing to convert from LLC to C corporation.
Mm-hmm.
So then when you pay C corporation taxes, you pay corporate taxes in the United States, you normally pay 21%. So, just it's the standard tax, 21%. You pay the tax. You may also owe state income tax if you operate in a particular state, or if you sell into that state, amounts that are large enough in order to be taxed there. We call it nexus. We're going to talk about it later. But if you end up working with the state a lot, like California, New York, high tax states, you can get taxed another 9% or 10% or more if New York and yeah, Massachusetts is also high tax. Okay, you have to consider that. And then, of course, second layer of tax, second level of tax is when shareholders pay themselves dividends. For US people, and we're primarily here focusing on non-residents, but for completeness, for US people on federal only, plus states, but federal only, you pay tax at 23.8%.
Mm-hmm.
So in other words, you pay 21%, that's 79%. And then from that 79% that's left of your net profit, you have to pay another 23.8. So there another 20, $3, I guess. I mean,
Mm-hmm.
1/5 of that. So overall, you could see how it can be substantial. But for foreign for foreign shareholders, it's even worse. If you are from a country with which US doesn't have a treaty, then you can be taxed at 30% on dividends. So that's pretty high tax right there. And of course, treaties can reduce this to somewhere between 10 and 25%, mostly 10, 15%. But if it's a foreign corporation that owns this US entity, then the withholding tax would be only 5%. So it's going to be better, but then, of course, you have to pay tax on that other country where you live.
Mm-hmm.
So yeah, so that's where how opaque is different. You can appreciate that in pass-through, you only worry about one level tax, and if you structure correctly, you don't pay anything in the US. Here, you're literally subject to at least double taxation in the US. Okay,
So
that's
I have a question regarding this. So
mhm.
why then entrepreneurs so used to corporate C corporation?
We will, yeah, that's a great question. We will actually have several slides on this, so
Okay.
I will give all the details about
All
it.
right. Mm-hmm.
I mean, of course, it's as usual in life, there is some give and take, and there are some advantages. We're definitely going to look at advantages a little later, okay?
Okay.
But this is an excellent question. So And but here you go. This is the key benefits. So still it limits tax exposure somewhat for foreign owners, because if you recall, if you have pass-through entity and you do have US business, shareholders must file their personal tax return, or members have to file their personal tax return. Here, okay, maybe you pay 30%, but you don't have to file any taxes. I don't know, for some reason, some people simply don't want to file anything personal in the US. So just like, okay, so then, oops, foreign shareholders don't need to file this tax return. That's one point. Um, Pay tax and dividends and so on. Strategic use acts as a blocker. So basically, it acts as a blocker again. So if you don't want to worry about ECI, effectively connected income, if you don't want to worry about FDII income, that can be taxed on gross. Remember how I was talking last time? FDII, if you're not careful, you could be taxed on gross amounts of money that you make without considering the deductions. This entity guarantees that no matter what income you get a deduction. Yeah. So in situations where it's risky or definitely not good, so that's the way to go. Another one, it's non-tax reason. It is preferred by VC. When you open C corporation, Delaware, everybody knows this jurisdiction, how the laws operate. You probably also can appreciate that point, So it's well kind of established. And then they don't have to worry about pass-through income as well, or losses. And then also we mentioned about it last time as well. When US entities work with foreign entities, very often foreign jurisdictions request the US entities to present residency certificates to prove that they tax paying in US. You know that, yeah. So, and LLCs, if they're completely transparent entities, they don't get that. You see, and as a practical matter, sometimes you want to get it right. So you want to work with somebody and not to be subject to, maybe 30% withholding tax at source somewhere else. So that could be a significant advantage as well. All right. Therefore, all the structures, you have to be careful. Sometimes maybe you can create 2 entities or 3 entities and use each of them the way, if you have a big enough business, right? Okay, so then, but of course, these opaque entities, they also have some tax breaks. Okay, I told you that the tax on them is 21%, but if you make foreign sales through that entity, the tax goes down. It's so-called FDII. Yeah.
That's a cool thing.
Yeah. It goes down. Somehow they want to promote U.S. business, U.S. produced goods and services, and so basically, so it's foreign derived intangible income, although it applies not only to intangible. So it's 13.125% through the end of 2025. And okay, 2025 is almost, well, still half a year to go. But guess what? You only pay 1,300 and 125,000. Then you have 16%, 16.4% starting from 26 onward. So I think it's significant break, in my opinion. Yeah, and then eligible income. It's not exactly eligible income. Okay, so what you have to do is you have to prove foreign use. So basically, you cannot sell something, and then that it's going to be used in the US through some sort of arrangement. When one person sells there, the other person sells back. Of course, you have to do all the records, a proper expense allocation, but you can do expense allocations by simply prorating, unless it's very different. Yeah, so anyways, and then the example here, you have 1 million in foreign SaaS income, you only pay 131,250 tax in the US. There are some nuances about it because if US entity has a branch in a foreign country, and sometimes when CEO lives in that foreign country, that's considered to be a branch, though any income attributable to that branch will not be availed this tax break.
So
But there's
let me clarify this. So, for instance, the CEO or director lives in Spain, and he operates U.S. based entity and C corp, and he sells his application all over the world, right?
Mhm.
And so how it's going to be treated there?
Yeah, so for in some ways, we would need to measure how much of income is net income is allocable to that branch.
Mm-hmm.
Okay, let's just say CEO, he works day and night. He's by himself. He's a CEO and another, technical director. So they work day and night and making this happen. And then we'll probably allocate a lot to that CEO because he's the kind of main driving force behind all this. But mostly, so let's just say they sell 1 million. Let's say 500,000 will allocate to CEO and 500,000 will allocate to this technical
Uh-huh.
person. Let's say they have 1 million of net income. So
Uh-huh.
then for 500,000, they'll pay 21%.
Uh-huh.
And for the other 500,000, they'll pay 13%.
So it means that the individual who runs the entity is considered as the branch, right? And he is kind of
Yes.
earning money for the company. Ah, that's
Yeah,
cool.
yeah, 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 yeah.
I didn't
Formally,
know that.
right? So yeah, but yeah, but I gave you extremely, extremely rare case. Usually, people have a team, right? If they
Yeah, of
sell
course.
something successfully, there is a team, and what do we usually do? We allocate some sort of normal wages at normal kind of profit. We'll say, okay, maybe assume, so sometimes they get paid. When they get paid, we'll just basically add certain percentage on
Mm-hmm.
top of it. If
Mm-hmm.
they don't get paid, we assume, let's say, if you were compensated, you'll maybe making X amount of dollars per year,
Mm-hmm.
and that's how much profit on that amount of dollars you would be making, and therefore that part of profit we don't tax. I mean, we tax at 21%, and the rest, taxed at the
Mm-hmm.
good rate. So that's, yeah, that's kind of the rules that they want us to follow. But of course, all this profit allocation is extremely subjective. So, but we just follow some statistical methodology. But sometimes it's a little more specific, given circumstances, of course. Okay, so another problem with opaque entities, and I think that everybody should very, very carefully listen to this one. Big problem is tax on liquidations. So literally, today is a good day. You put in your IP, okay. You try to raise investments. You put everything that you've worked on for a few previous years, and then let's say you decide, okay, maybe it's too complicated. Maybe you have, investors in other jurisdictions. You don't want to do it anymore tomorrow. And then when you want to liquidate tomorrow, you have to pay corporate level tax on all of this AP. It's amazing. So the rules are very, very insidious in some way. Have to be very careful with them. And that is one of the main reasons why I think whenever possible, founders should try, well, not founders, but put it this way, investors of specific technology that just try to test their waters in US market, at the very least, do not put IP into the US corporation, into the US opaque entity. It's better structured. You hold your IP, you sub-license it to US entity,
Mm-hmm.
and then US entity resells it and they pay you what we call it, royalties or license payment. No, if no money is made, you can even say my license payment is $1 a year, right? As you know, you can probably say it's $1 a year for the first X years, and it's fine. And it works. Everybody is fine with that. You know, there is no like law that you have to pay royalties. But that's the way to go. And only when you already have things signed with all the potential investors and whatnot, it's okay. At that point, here's what I'm going to put my EP in, investors put the money in, everybody's happy, and on you go, right?
So it means,
so this is real.
Dima, so it means it's very easy to enter the US, the US corporate, let's say structure. Yeah, but it's quite expensive to come out from it in case you haven't raised investments, so etc. The venture didn't work out, so it will cost you.
Yeah, that's right. And you wouldn't believe how many people every year, how many people we consult, and then we hire transfer pricing study specialists. And then we say, this company is going out of business. There is a little IP remaining. This is what we're going to do next. This is the value. And somebody have to come in or actually this is valuation. So we will find a valuation specialist or transfer pricing, depending on what the situation is. Sometimes they sell, sometimes they take the IP and sell to another entity, foreign entity. So then we need, transfer pricing and valuation people. So they have to come in, look at it.
Okay, so thank you. That's I have faced these troubles, including our case when we worked together, and I must say it's a pretty serious one. And now I'm always I always advise my clients who enter US always to take care of transfer pricing, and always keeping your notepad number of the transfer pricing accountant and CPA who will act as the one and who will help you to cover it.
But especially when you try to make some kind of large transfer of IP or large transaction, because when it's very little money, you probably okay just to do your search online and do. But once there's a big, so you're definitely better off, because the penalties there are extra penalties for undervaluing what you're doing, between the related entities. And I think it was at 40% of the underpaid tax. So it's very, very, very large. Okay, so that's the tax on liquidation. Now I wanted to talk about a little more industry specific. Remember how we said this presentation will give the general idea of what's going on, but we're gonna structure it and tailor it to the software companies,
right?
Companies that
that makes sense.
Right.
By the way, by the way, two questions. Shall we all review Delaware as the tax haven? Shall we talk about it?
But Delaware is not tax haven. It's normal state.
I know that, but just recently we have a client who was advised that you should go to Delaware because it is considered as a tax haven. Everybody do that. Just go there. I said, whoa, stop, guys. Let's not be so confident that
I'll say no. It's not necessarily It's not necessarily Delaware. It's an LLC entity. When it works out for your type of income and for your client positions geographically, any US LLC, Wyoming, Delaware, Nevada, any US LLC is going to have the same exact properties. So in US, I think almost all the states have LLCs, but maybe some don't, but it doesn't really matter. There are 50 of them, plenty of the ones that do. And it doesn't really matter in US, Delaware is considered extremely normal, proper, and actually most popular state. So that's everybody's in Delaware. But for LLC, remember how I talked about is transparent. So if you don't touch down in US, if you don't have a US source feed up income, well, then you escaping the whole taxation thing in the US and in other countries. And let's say you live in a country where LLC is a hybrid entity, that is, in that country where you live is not subject to tax on your income earned inside of that LLC. Okay. And in US, you're not taxed as well. Well, then put two and two together, you are in tax haven. And one of the places that are most popular, Delaware in the world. So, it's in that sense, it is tax haven, but it has to be on narrow set of circumstances.
Got it. Thank you.
And right. And yeah, so, but we can talk. So if anybody wants to get it in detail, they can send me
I
email.
think
We can
I,
we
I
can meet.
think I think we should dedicate the separate webinar regarding Delaware.
Mhm.
Just to get a closer look on this state, because there's so much gossips and
Yeah,
I would say
yeah,
fairy tales about this, that we need to
yeah,
give more clarity. So I think we should do that. It shouldn't be very long, but we should get into it.
yeah. We can mention, yeah, but as I said, in all honesty, any United States state is exactly the same as Delaware. It's just Delaware laws are a little more settled because they've been doing a
Yeah.
lot of that, working with companies and so on. Yeah, but anyway, but speaking more specifically about the industry, in industry sales. So there is this new law, as advertised previously. This is very recent. It sort of confirms what they were proposing for many, many years. But if you can imagine, as you can imagine, for so many years, internet exists and a lot of businesses are made and remade on the internet. And just now, IRS clearly spelled out in finalized regulations, so it's a formal law on how they view internet transactions, okay, and where do they file them, all right? Okay, so they look at them as follows. It could be transfer of copyright rights. um, what it is for, yeah, you understand, right? So let's say you have a copyright rights and somebody buys them to offer to their clients. Like, for example, if you have you're not putting IP inside of US company, you simply, license IP to your US entity, and that US entity resells it to various individual users. Okay, so that's transfer of copyright rights. So it can be royalty, licensing income, or you could sell it into the US entity as well. So that's also possible. Transfer of copyrighted article. It's also can be sale or license, but basically what it is, if you're an individual user and you download a software, you pay $10 for it, either just $10 and you can use it forever, or you pay every year $10 or every year $100. So that's going to be transfer of copyrighted article. So you got it, you downloaded it, it's yours for time being or forever, but that's the article that is specific just for yourself. So that's how they classify it. Then you also could have provision of services, which is custom software development. Again, so if someone would like to develop some software, you do the coding and you send the code over the internet to them. That would be provision of services and custom software development. Okay. Then provision of know-how. It's a little different from transfer of copyright rights, but it's basically, you could say, well, I'm going to give you this procedures, or I'm going to give you this way of doing things, and I can either pass it on to you, or you can use it for a while, and then I'm going to retain the rights. Perhaps if people don't, sometimes people don't want to patent things, and just basically know certain things, and you probably know very well what it can be, right? Provision of know-how. But it's very similar to transfer of copyright rights. Is basically you can either sell it, you can license it, and yeah, and different rules will apply. So then, why is it important? And then there is one more. There is one more. Is a software as a service.
Yeah.
This basically, you have a server somewhere there, and people log into that server, and they can use whatever stream or use whatever you want to use, and then they log out, and that's what we call software as a server service. There you go. So, why these distinctions are important? Because in every case, once the decision is made, we have a special rules about what source this income is. And the source is important is for determining how and how these sales are taxed and where they're taxed, basically. Like what if you're in a foreign country, you sell into the US? Is it going to be source of income in the foreign country, or is it going to be sourced in US? Because you could look at these things from both points of view, right? I did this here, and I'm having my servers here, and somebody licenses this from me over there. You would think, well, no, I have to pay tax here, but there are some rules they say that that's not the case. And there were arguments for a very long time. And they finally settled this past January. It's amazing. I think they were afraid of Trump so much. They were just, okay, you know what? We have to settle it as soon as possible before he actually nixes the whole thing. Anyways.
Yeah, because it seems like it brings additional taxes, additional taxation, as far as I understood, right?
Because last time, you know what happened last time? Trump said that for one new regulation that is finalized, you can cancel two. You have to cancel two. So that's why. So before that kicked in, they just wanted to be done with that. But good for us. I think it's good for us. All right. And here's the sourcing. This is like the meat of it. So here's the sourcing rules. So when you sell copyrighted article, meaning that you download to your computer and it's yours forever. And regulations are very clear. You have to look at the billing address of the buyer.
Mm-hmm.
So you looked, where did they buy it? Okay, there, this is it. Then this is source of that country, and so and everything else starts operating that way. When you lease or license anything, so copyrighted article lease, know-how, patent lease, anything, then it's sourced to the place of use. And the place of use is as follows. Let's just say you are a multinational company and your sales around the world, United States, everywhere. And let's say you lease or you rent some IP, right? Pay licensing fees. Then you measure. So here's my sales, and this is who's buying from me in the United States, or here's the users of my services in the United States. Here's the users of my services outside the United States, and we allocate to United States or outside the United States based on those proportions. Okay. So that's kind of where it's used. That's where the licenses and leases help. Then the services, that's amazing. So let's say you live in a foreign country, not in the US, and you do the custom software, or you do SaaS as a service, which is also here allocated similar to services, the same way as services, and you do all of it outside the United States. Well, then when you send something to the US so when you receive money for this from the United States, put it this way, then the source of it is outside the US. And that's very important. That's why it's very helpful. That's why people who run custom software, they can services. They can easily operate outside the US, not have anything inside the US, and not be subject to the tax at all. So that's very good. Then, of course, when you have sale IP or know-how, then if you sell your IP or you sell know-how, then it goes to the residence of the seller, which in this case, if we're talking about foreign founders, then it's going to be outside the US as well. So that's why
Even
there are
so.
some. Yeah. So when you don't lease, you don't rent, lease, or getting royalty for it, but you simply sell it outright. Let's just say you develop a software and then you have some business that would like to buy software from you. And you live, I don't know, Spain or maybe I don't know, somewhere else. Um, even if you live on some sort of island with which US doesn't have a tax treaty, could be, I don't know, some sort of island, and you sell it to the US outright, meaning that you don't own the rights anymore. It's, you remember, right? You say it's perpetual exclusive. So you sell perpetual exclusive license, meaning that you cannot use it anymore. It's exclusive to the person who bought it. Well, in that case, this is it. You don't pay tax in the US because it's complete outright sale of IP and know-how. And there are some transactions done that are structured that way. Let's just say you work for a year, there are no contracts, you're basically developing software. And once you're done some good chunk of something, you sell it into the US and you realize income. And in some situations it might be beneficial for US corporation, but at least it used to be. Right now probably not that many cases left. But anyways, so that's it. That's that. Sourcing, very important. Okay, now I was talking about the other four. This is the same thing about SaaS. Again, to repeat ourselves, cloud transactions are always classified as services. And here's something to think about. SaaS, like when you do custom software development, that's pretty clear. You just do software development and you upload to Jira or something, right? You upload somewhere. But with SaaS, it's different. In addition to personal services, you have to have servers somewhere, the physical servers that's sitting somewhere. And the situation there is a little bit fuzzy, just a little bit. So it's a risk area. If you run a SaaS business and you have servers in the United States and you own those servers, you service them, you operate them, well, then you have very high risk that they will consider it as doing business in the US. And if you try to do it through a pass-through or transparent entity, they might start taxing you. Okay. So it's a risk area. I would not. So if you live in a treaty country, and then the treaty benefit, they really would require that you own the server. Like say, if you use Amazon, they own the server. All you do, you rent from them. Then maybe it's not going to be so daunting. The risk will be a lot lower. All right, even though it's not going to be zero, but okay, it's going to be a lot lower. And if there's any problem, the level of tax also going to be less, on a lot less income. But if you live in non-treaty country with which US doesn't have treaty at all or treaty suspended, well, then I think that that would be not advisable. Even running Amazon servers, even be Amazon servers would be risky. In that case, I would say you better choose just C corporation and try to lower your taxes with paying higher royalties that go to your home country. So, all right, that's that. Therefore, the class. So you have to be careful with this. That it's not only people, but also servers.
So it means that servers basically can be considered as the place of running your business, right?
Yes, yes, they can. They can.
Even if your dev team is not in the US, you're not in the US, but you run servers and you sell, for instance, partly to the US customers and abroad, you'll be considered as a US based company, and all these transactions should be taxed in the US.
Yeah.
Mhm.
Right. So they can be partial. So they don't need to, you need to pay tax on everything, but it's very annoying where you ask to pay something. Because remember what the penalty is, so to speak. The deal is that you have to file personal tax return. Then you have to understand how much is generated by these servers. Then you have to measure whether or not your foreign income, I mean, the income that you sell to foreign parties can be excluded from this whole. It just boom, it's like a can of worm, as they say, in
I
English.
see.
So all
I
of a
got it.
sudden, it's a lot, the right. And then it becomes very complicated. But as I said, if you live in a treaty country, if you rent, you should be probably okay. But even then, I always recommend, at least if you have to, absolutely, like you have no control over Amazon, right? So let's just say, you know what, here's the service. But then at least have some important servers for sure outside the country. And then if anything comes up, at least you can say, you know what, that's not our preference. We still also have servers outside the country. We're not targeting US as the place to keep servers in, and that could, be in your favor. Okay. And of course, as I say again, so for C corporations, it doesn't really matter because everything was taxed in the US. It's only for transparent entities when it comes into consideration. All right. So far, again, all right. So we talked about the difference between transparent opaque entities, effectively connected income, FDII income, FDII. We just talked about how you can pay less tax on corporations if you have foreign sales. We went over dangers of tax on liquidation or IP transfer out of US of C corporation. That's a trap, big trap. New sourcing rules, we just went over them for SaaS, software development, sales, and licensing. This is summary of what we have done. So next,
Dima, maybe in this case, we should make a pause because it's already
sure.
almost
Yeah.
45 minutes, as I mentioned.
Yeah.
We run it as a lesson, as a school lesson.
Yeah. Okay.
But
Sounds
if you don't
good.
mind,
Mhm.
let's do the third one, and I have few questions to the previous
Okay.
slide. Could you please
Oh,
move
previous
back?
slide. Yeah, of course.
Yeah. So just a few clarifications. First of all, for instance, most of the startuppers, they establish C corp. Most of them, they live abroad, and they will develop software and sell it as the SaaS, or it's outsourcing. Let's say this. So most of the cases, it's a SaaS or outsourcing or outstaffing company. So in this case, what are the key advices from you? Could be to the people who run a software development with the final product, final solution for the users, and outsourcing company. So first, it's a startupper. They want to raise funds. Based on this summary, key topics. What are your
Okay. Sounds good. Okay. So you want to raise funds. If you're talking about raising funds from US investors,
right?
then they're not right. They're not going to. It used to be okay. So there's actually another thing. Another big problem in the United States that I forgot to mention. I thought about putting in the slides, forgot, but we need to be aware that research and development expenses in the United States are not deductible.
Yeah.
Okay, so that's
Wow.
one of the huge minuses for C corporation. Okay, it's deductible. Foreign research has to be amortized over 15 years. So in a matter of 5 years, you'll deduct a third of it. You know, it's not very useful, you know, if you have income. And it's a big problem. I think that law exists since 2022, and we were just like wiggling around it, and they tried to come up with regulations to make it softer, like they try to exclude small businesses from it. They're thinking about it, but you know how it works, very slowly. Yeah, so but it's in development. We'll see what happens, but for now it's a big minus actually for C corporation, because you pay tax in the US, cannot deduct expenses, and startups mostly do as an R&D. So you know, right? Therefore, if it's you, and it used to be that US. Um, uh, some of the US investors, they wanted to invest through a pass-through entity, because it used to be that research and development you can deduct immediately, you know, before anything else. You can just quickly deduct research and development. So what they would do, they would form companies, they need deduction, they will get a deduction on their tax returns. They would start as an LLC, and then once they spend the money, they would convert into C corporation and on the go. So we have many entities like that. Right? Yeah. So and then they lose, like hopefully not lose, but if they do lose, okay, at least you got a deduction. Let's also have a problem with ordinary deduction or not ordinary deduction. So they didn't risk
So
that much.
LLC,
Okay.
so LLC
Yeah.
can deduct this, right? R&D.
No. It used
As
to be that way.
it used
Yeah,
to be
it
that.
used to be. Yes.
Mhm.
I was telling you, right. The reason I'm mentioning that, I was trying to mention when US investors might be interested in investing in LLC. So if they can take those deductions right away, well, then they might be interested. But
Ah,
most startups,
not the
they,
case
you
now.
know, they not the case, exactly, not the case now, not the case. And they simply just go ahead and, you know, uh, not deducted. So there's no point in this anymore. So now, if you look for money outside the US, and if what you're going to be running is business that runs from outside the US on global markets, partially in the US, but mostly maybe on global markets, then you definitely don't create the big holding entity as as a C corporation. You create it as an LLC. And then if you want to have some sort of blocker for US income, as we discussed, right? ECI, FDII, all those crazy dangerous words over here, ECI, FDII. So then you can shield yourself via US entity, and we call it a blocker. So that US entity will be reselling, you know, software in the United States or whatnot,
I see.
and the rest of the structure will be shielded. So and actually see things done this way. And sometimes they actually have this US LLC, and then you have entity United States, entity in other countries. Right now, for some reason, in Latin America,
So,
have a lot of expansion through US, yeah, but with use of US LLCs, yeah.
so you're talking that you can set up a LLC holding, right? And to put the C corp as a blocker for the US market, right?
Yeah, exactly. Yeah. So you could do
Interesting
holding, or
idea.
it can be even operational. It just can be selling to other countries' market
I got it.
if you have to operate through IRS, through US entity.
Mhm.
But to US, if you do something that puts you at risk of this
I got it.
FDII and ECI, then it's easier just to do. Yeah. So
Okay.
that would be the most flexible approach. Mhm.
So in this case, if you're a startup, or how you can avoid this trouble with R&D non-deductible expenses, or there is no
Very
way?
good. Yeah, yeah. No, there is a way. There is a way, and this is what we've been sort of, recommending to some people. Again, you might want to have foreign, I mean, U.S. investors to buy into it, but you can definitely do it. I don't know about the legal part, and maybe here I would love actually to hear from you, Zhenya, regarding the legal part of it. Let's say, imagine the structure: you have a U.S. holding LLC, U.S. LLC as a holding entity, and then you have U.S. corporation on one side. Let's say CEO lives here in the United States. Let's say, who else? I don't know, salespeople live here, And then you have another corporation somewhere in a foreign jurisdiction, taxed as a corporation, not as pass-through, but as a jurisdiction, that holds the IP and develops the IP. So they
Right.
hold IP, they develop IP
Uh-huh.
themselves. All
I
right.
see. So it's an IP holder,
And
and all the IP is stuck there.
outside the US.
Hmm.
So in effect, what US has done with this law, it pushed IP out of the US.
I
It's
see.
very dangerous, very inefficient, very bad developed IP in the United States. It's much better keep it outside. Now, of course, under certain circumstances, we have these rules for controlled foreign corporations. If few U.S. people control more than 50% of the company, then there are some problems. But if we're talking for foreign founders and maybe minority U.S. investors, this kind of structure, if U.S. investors buy into it, and here's my question to you, Zhenya, how do you think IP is protected outside the US? You think it the same protection or much worse?
I would say in the US, IP is protected in the best way. That's for sure. I consider US as the standard. But in comparison with this risk of non-deductible expenses, then you started definitely to look for the alternative. So from my perspective, what I see where people moved or moves their IP is Ireland is more or less good. Cyprus is quite often is chosen by the startuppers and already mature companies. Sometimes Malta, which I consider not a good place for IP. Sometimes when you have a mature company, you can land in Switzerland, where you now is situated, and there are some other places where you can host IP, but the way IP is protected in the US and the enforcement of the protection is the best developed in the US. We face this as the advisors of our clients who were kind of sued for non inappropriate usage of the IP of some third-party IP. So I can say that it can be done very fast and effective to protect your IP in the US. So I agree with you that it was a shot in the leg of the IT
Yeah,
tech industry of the US. So
right. Very interesting. Thanks for sharing this. And I would add also from what I hear and observe from people with whom I work now is that both Ireland and Cyprus have pretty good what they call IP box regime. I
Right.
think Ireland also has an IP box regime.
That's true.
So they're actually moving to precisely opposite direction.
Yes.
They made it,
Yes.
so Cyprus, you can pay, from what I know, I'm not specialist in Cypriotic tax, but okay, 2.5%. Can you imagine?
Yeah.
On the profit tax.
Yes.
So it's
That's true.
20 less.
That's
Yeah, 20 less.
that's magic. That's magic. Dima, I think we need to wrap
Yeah,
this
let's do.
this session. I think it was a great
Sure.
one. More and more practical advices. I'm sure that we can develop this topic on the next meeting, because now we're coming closer to the things that actually important for the setup of your business. So next slide that you just opened was how to choose jurisdiction and how to operate it. Most probably, right? Yeah, foreign-owned software business. I love it, and it will be great to go deep into this topic. Thank you,
course.
Dima.
Yeah.
Thank you, Dima.
Happy to do it. Thank you, Daniel. You have a great rest your weekend. Have a good weekend.
Thank you. Thank you
And
for all of
see you
the
next month.
yeah. Thank you
Of
for all
course.
of the visitors. We talk to you and see you soon in 1 or 2 weeks as usual. Thank you, guys. Good luck,
Yeah,
Dima.
awesome.